retirement is just a few years away, it may be time to adjust your investing strategy.
The shocking statistic is that by the time somebody reaches 65, 95%, they're dead broke, they're dependent on family, or they're dependent on government.
It's important that people deal with someone to make sure to prove and provide that guaranteed lifetime income.
Welcome to the Retirement Architect, David Reyes. Our program is designed to not only provide insight, but to educate and to give you the tools you need to help you design and build a rock-solid retirement.
You know, I was meeting with a client, a prospective client last week, and I really thought about you all out there, sitting down talking with him afterwards. And, he was pretty upset. He came to me, and he took advantage of my second opinion that we'll talk more about in a little while, where I'll review portfolios and plans. And so I was happy he took me up on it. He was actually a listener just like yourself. So I'm very proud that he did that. And it was really interesting because we were going through, retirement planning and tax planning and all different types of aspects of his retirement and of his well-being for him and his wife. And as we got into it, and I was reviewing his assets, his investments specifically, he made an interesting observation that I've been making for a long time. And so it was kind of neat to see. It was one of the few times I've had clients come to me with this specific of a concern about their portfolios. And what he said to me was, he said, I asked him, I said, he already has an advisor right here in San Diego, which is not uncommon. And he said to me, David, he goes, I'm really underperforming, the markets, and I have for a while. And he goes, I can live with that a little bit in the short term. I'm not that picky, but over the long term, I want to do well. But he goes, what I'm really mad about, and part of the reason that I'm here is because I own about 40% bonds in my portfolio. And what really upsets me is I looked at what the bond yield was on my portfolio, and it was like 0.5%. And so he goes, I'm paying my advisor a fee to manage my money, 1% of the assets, and I'm paying him more in fees than I'm earning in yield in my bonds. And he goes, on top of that, I'm really worried about rates rising and me losing money in my bond portfolio. And I said, you know what, sir, that's an awesome observation. And if you listen to me long enough, I'm not really a big fan of bonds. And I use what I call bond proxies, which we'll discuss later. And as we got further in the conversation, I said, you know what, I agree with you for different reasons. I mean, I agree for sure it's not very fun to be paying a fee that's bigger than what you're making on a big portion of your portfolio. And he was in like 1-year bonds. Now, let me tell you why the client would be in 1-year bonds. To give you an example, 30-year bonds are returning about a 3% rate. 10-year bonds around 2%, and like 1-year bonds are under 1%. So, but the reason his advisor has him in those types of bonds is he's trying to reduce the risk both in the portfolio and also the interest rate risk that occurs as you get further out in the number of years you own a bond, or what's called further out in the yield curve. And so I kept speaking with him and I said, well, here's my concern for you. Not only obviously that issue, but really, what rate of return are you going to earn on the bonds? Number two, there's obviously the inflation risk, which will increase or decrease the value of the bonds. And so, more importantly, what he realized through different ways than I did is that there's really no rate of return you're going to receive. It's very small, and you have risk. And so you have a huge 40% of his portfolio really has no contribution to the future value of that portfolio. Now think how horrible that is. So again, 40% of his investments is going to have no meaningful value to the portfolio. Now I'll tell you what it does do, and I'll tell you what it doesn't do. What it does do is reduces the volatility theoretically of the total portfolio. Even though 90% of your risk in a 60% stock, 40% bond portfolio is due to the stock allocation. So 90% of the risk is in stocks. So, but the point is that, what do you do to rectify that situation? And that's why I do not advocate having a passive portfolio that has bonds in it for retirement portfolios. because there's no value to that particular asset class right now. And if there is, if you decide you want to be more aggressive and buy high yield bonds or own 30-year bonds, for every 1% rise in interest rates of a 20-year bond, you're going to lose about 16% of the value of your bond portfolio. That's pretty heavy. And on a 10-year bond, you're going to lose about 8% for every 1% rise. So the question becomes, what are some of the alternatives to do that, to actually create less risk and to create more income? And a real simple solution, there's a lot of solutions that we have, at least a handful. And I'm going to start with the easiest one first. So I've got a paper right here from the Wall Street Journal, and I really like this. And first off, if you want to receive a complimentary second opinion from me personally, David Reyes, to go through your portfolio, to go through your Social Security, your taxes, your estate plan, all of that, just give me a call at 1-800-611-1967. That's 1-800-611-1967. Or you can reach me on the web at reyesplan.com. That's REYES plan.com. So let me pick up with this Wall Street Journal article. And the title of it says, "Say Goodbye to the 4% Rule." And, it basically says, can your nest egg last your whole lifetime? And quite honestly, that's the major thing we can concern ourselves with. And we have what's called the 3 Ps in our practice. Number one, we want to prepare and plan. Prepare and plan. I like prepare better because I call it more of an action word. Let's do it now. And of course, plan. That they're one and the same. 2 is we want to protect. We want to protect what we have, because my clients, like most of you out there, have already what I call won the game. You already have enough assets. It's just how do we maximize the distribution of those assets? Because after all, what matters more than anything is how much lifestyle I can sustain without running out of money the rest of our lives, including taxes, inflation, all these things that are attacking your portfolio that you need to be worried about. So getting back to the 4% rule here in this Wall Street Journal article, basically, a long time ago, there was a gentleman by the name of Mr. Bengen, if I'm saying that correctly, and he advocated a 60% stock, 40% bond portfolio. And this was back in the 90s when interest rates were around 6%, so totally different time frame, and the stock market was going crazy. Okay, so we had a really upward trending stock market. And if you took 4% out of your portfolio, that's what the 4% rule comes from, you basically could have, with inflation and taxes, you could have your money most likely last the rest of your life. And that's what we want. But unfortunately, we don't live in those days anymore. Interest rates are what? You're talking 2% on a 10-year interest rate. They were 6% in the 90s. So that's tough. And to give you an example, so if you had a person that retired in 2000 and they took out 4% withdrawal rate on basically a 55% stock, 45% bond portfolio, and you had a 3% inflation rate, your portfolio would have fallen by 2010 by over 30%, and you'd only have a 29% chance of not running out of money during your lifetime, during your retirement lifetime. I'll tell you what, those odds are horrible. And when we're constructing portfolios, that's just unacceptable. None of my clients are in that situation. So the question becomes, what do you do? Remember I told you we use bond proxies. So I can tell you the simplest rule, and if you've listened to me long enough, I always use the term Occam's razor. And Occam's razor is always when all else fails in this barrage of information, the simplest solution will always be the best solution. The simplest solution is let's take that bond portfolio that's earning nothing, that has high risk, and let's just purchase a simple annuity. Okay, there's all kinds of annuities, but who cares? Buy an annuity. And this is really one of the times I advocate buying annuities. And we use them very specifically, very sparingly, because I think they're great vehicles for certain clients and in certain situations. This happens to be one of those situations where pretty much no matter where you're at, if you have assets under $2 million, this is something you should be looking at, especially under $1 million, no question, is that let's replace the bonds that are earning nothing, like this one client of mine was earning before me less than 0.5%. What if we could buy annuities in place of our bonds so that 40% bonds is now going to be 40% annuities? We still get our stocks, but now we're going to have a distribution stream for the rest of our lives and your spouse's life of anywhere from 5 to 6%, depending upon your age. So imagine you get 5 to 6% for the rest of your life for you and your spouse, 100% of the benefit, okay? No matter who passes first. That's what I call a plan, because now I've given a benefit to those bonds. Like the client said before, David, what am I paying this advisor for to have me earn 0.5%? Well, in this case, we're taking out 5 to 6% the rest of our life. So if you want to know how we look at portfolios and how we construct really good portfolios and really good income portfolios as we get closer to retirement, give me a call, 1-800-611-1967. That's 1-800-611-1967. Or go ahead and visit me on the web at reyesplan.com. That's REYSPLAN.com. This is David Reyes on AM 760 KFMB.
You're listening to the Retirement Architect, David Reyes.
Common sense or amazing guesswork?
No guesswork here. The Retirement Architect, David Reyes, will continue next.